Three major brokerages have issued a coordinated wave of target price revisions on overseas Chinese banking corporation, arriving at remarkably similar clusters right before the mid-year reporting season opens. The prevailing institutional consensus is shifting rapidly, pivoting away from a traditional passive income lens to focus heavily on wealth management expansion, insurance realignment, and corporate balance sheet resilience. This episode covers the growth catalyst from UOB Kay Hian, the valuation metrics and asset quality buffers from DBS Research, the earnings momentum from RHB Research, and the consensus map revealing where analysts agree and where they leave massive questions wide open for retail investors. As mid-year reporting season approaches, three major brokerages issued coordinated target price revisions on OCBC, arriving at remarkably similar clusters. The old lens on OCBC was passive income and dividends. The new lens across all three brokerages is wealth management expansion, insurance realignment, and balance sheet resilience. Institutional consensus has pivoted away from the traditional income narrative. This report covers four things: the growth catalyst from UOB Kay Hian in wealth management and insurance, the valuation metrics and asset quality buffers from DBS Research, the earnings momentum and dividend yield view from RHB Research, and a consensus map showing where analysts agree, where they diverge, and where they leave the biggest questions open. Analyst Jonathan Koh of UOB Kay Hian maintains a buy rating with a target price of $29.70, positioning the wealth management and insurance divisions as twin growth engines. For Bank of Singapore, aggressive relationship manager hiring and subsequent asset under management expansion are driving non-interest fee income. Meanwhile, Great Eastern Holdings is undergoing a comprehensive high net worth repositioning strategy under its new Chief Executive Officer to capture a larger share of affluent insurance placement across Southeast, establishing a capital-efficient cross-selling pipeline directly between the retail network and the insurance manufacturing arm. The strategic realignment taking place within Great Eastern Holdings aims to tap affluent clients and deploy high net worth insurance products across Southeast Asia markets. This operational model relies heavily on building a capital-efficient cross-selling pipeline connected to the core retail network. On the capital management front, a key catalyst emerges as approximately $800 million remains unutilized from the bank's previously announced share buyback program, signaling a distinct possibility that management could redeploy these remaining funds toward a special dividend for shareholders if macroeconomic conditions remain stable. $800 million in unutilized buyback funds sits on the table. If macroeconomic conditions stay stable, management could redeploy it toward a special dividend. But the core buy case rests on the wealth franchise expansion, not on that possibility. Insurance and wealth as twin growth engines signals that interest income alone may no longer be the primary differentiator here. The question I keep coming back to is whether these flows can scale quickly enough if regional economic growth softens. Lenders across Singapore are increasingly relying on fee-generating insurance products to offset potential cooling in net interest margins, and this is part of that same pattern. DBS Research analyst Louis Wen Lim issued an updated report maintaining a buy rating and raising the target price to $30, making it the most bullish valuation among the three firms. The core thesis rests on structural capital buffers, supporting a steady performance for the second quarter, with net interest margin compression fears easing as loan pricing holds up better than expected across regional corporate portfolios. Balance sheet metrics show exceptional core capital strength, with a common equity Tier 1 ratio of 17.0% and a non-performing loan coverage ratio standing at 163%. DBS Research points to two figures as the core of its balance sheet case. First, a common equity Tier 1 ratio of 17.0%, its measure of core capital strength against risk-weighted assets, and a healthy one at that. Second, non-performing loan coverage of 163%, meaning provisions held comfortably exceed every dollar of bad debt on the books. Together, DBS frames these as a significant buffer against any deterioration in asset quality. DBS Research does flag risk worth watching. Possible non-performing loan surprises from middle-market corporates in Greater China and ASEAN, credit cost pressure if the global recovery slows, and regulatory friction where cross-border capital flow rules could dampen wealth inflows. RHB Research analyst Shekhar Jaiswal released a note reiterating a buy rating and lifting the target price to $29.80, representing an 11% projected upside. The narrative projects a steady mid-single-digit growth trajectory for profit after tax and minority interest, supported by stable regional loan growth and commercial banking momentum. Notably, RHB stands out as the only report to explicitly lead with yield, estimating a forward dividend yield around 4% and positioning it as a supportive price floor that provides total return stability for institutional capital. Banking earnings stay structurally tied to macroeconomic health, and RHB is upfront about that. Regional diversification across Malaysia and Indonesia does act as a hedge, spreading the loan book beyond a single economic cycle. But that diversification only goes so far. Performance remains highly sensitive to interest rate benchmarks measured against global central bank policy. And RHB flags the next 2 quarters specifically as the window where that sensitivity matters most. Free subscribers get yesterday's story. Elite investors get 0-day breakdowns, the full Red Zone watch list, and institutional-grade cheat sheets, all before the market opens. It's $9 a month. Stop being the exit liquidity. Start being the analyst. Lay the 3 calls side by side and the picture is striking. UOB Kay Hian on the 6th of July, buy at $29. DBS Research on the 8th, buy at $30, the most bullish of the 3. RHB Research on the 9th, buy at $29.80. 3 different houses, 3 days apart, and every single one lands on buy with a target inside a 30-cent range. All 3 buy, target range, $29.70 to $30. That's an exceptionally tight cluster. The professional analyst community collectively agrees that wealth expansion, insurance adjustments, and solid capital strength justify a higher valuation multiple. However, this institutional enthusiasm introduces a distinct paradox for income-focused retail investors. 2 out of the 3 major reports essentially treat the dividend as an afterthought or a secondary byproduct of excess capital, focusing instead on relationship manager counts and balance sheet provisions. Even RHB Research characterizes a 4% yield as merely reasonable. 2 of the 3 reports treat the dividend as an afterthought, built around relationship manager counts and balance sheet provisions instead. RHB is the exception, and even RHB calls a 4% yield merely reasonable, not compelling. As the share price rises toward consensus targets, the entry yield compresses further. Less income play, more growth story. As the share climbs toward the $30 target, entry dividend yield falls and the stock reads less like an income holding and more like a growth story. That mathematical consequence is unavoidable once consensus drives the price upward. Tight clustering around $30 confirms the market is fully pricing in a best-case scenario for wealth management growth. A compressed 4% yield changes the math entirely for anyone running an income-focused framework. The upgrades prove the bank is performing exceptionally well, but that doesn't automatically make it an optimal vehicle for high-income production. On the corporate side, the case is strong. A common equity Tier 1 ratio of 17%, real strategic moves in wealth, real insurance repositioning underway. On the income side, the question stays open. A compressed entry yield, a dividend treated as secondary, and whether that's still attractive depends entirely on your own yield threshold. OCBC is being upgraded for what it's building, not for what it pays out. A bank expanding wealth and insurance while holding a common equity Tier 1 ratio north of 17% is doing something right. But I keep thinking about my neighbor, who holds OCBC precisely because the dividend used to feel like the whole point. If you bought this for the payout, this round of upgrades doesn't change your math. 4% yield is still 4% yield, whatever growth story surrounds it. If you're buying fresh today, The real question is whether you're buying for steady income or because you believe in the wealth and insurance story enough to accept income as the smaller part. Both are reasonable answers, they're just not buying the same stock. Whether a compressed entry yield remains attractive depends entirely on how an individual investor balances absolute cash return against the certainty of a strong balance sheet. $30 from DBS, the most bullish target. A common equity Tier 1 ratio of 17%, non-performing loan coverage at 163%. A forward yield estimate around 4% from RHB, and $800 million in unused buyback capacity still on the table. Angela's content summarizes publicly available market news, analyst research, and earnings data for informational purposes only, without applying analytical filters or investment recommendations. Nothing here constitutes a recommendation to buy, sell, or hold any security. All investments carry risk, including the potential loss of principal. Always read primary sources and consult a MAS licensed financial advisor before making investment decisions involving CPF, SRS, or personal capital.